Hi, I'm Adrian. Welcome back to Premium Logic Lab. It's been 1 year since the tariff experiment began, and the results are in. They're not what either side wants to hear. Let me walk you through what actually happened, the real numbers, the winners, the losers, and what it means for your money going forward. First, let's set the stage. In early 2025, the administration rolled out sweeping tariffs. 25% on goods from Canada and Mexico, steep levies on China, and a wave of reciprocal tariffs on dozens of other countries. The stated goal was simple: bring manufacturing back, reduce the trade deficit, and force better deals. 1 year later, the scorecard is mixed at best. Let's start with GDP. In the first quarter of 2025, the U.S. economy actually shrank. First contraction in 3 years. The main reason? A massive surge in imports. Companies were racing to stockpile goods before tariffs kicked in. That front-running distorted the numbers. But then, growth bounced back. Q2 came in at 3.8%. Q3 hit 4.4%. Strong consumer spending and a drop in imports, partly because companies had already stocked up, drove the rebound. So on paper, the economy looks fine. But the story underneath is more complicated. Let's talk about prices. Tariffs are a tax on imports, and that tax gets passed through to consumers. Not always directly, not always immediately, but it gets there. We saw it in electronics, in auto parts, in building materials, in everyday goods at the grocery store. Now, the administration argues that tariff-driven inflation has faded, and there's some truth to that. A lot of the initial price shock has been absorbed, but core inflation is still sitting at 2.6%, above the Fed's target. And part of the reason it's not higher is because many of the original tariffs were rolled back, reduced, or riddled with exemptions. Liberation Day was supposed to be the big moment. In practice, it was more of a negotiating tactic than a permanent policy. Next, and this is the part nobody talks about, the stock market. The S&P 500 gained 17% last year. That sounds great, until you compare it to the rest of the world. South Korea's market surged 71%. Hong Kong gained 29%, Japan 26%, Germany 22%, the UK 21%. The U.S. underperformed nearly every major market. That's not what you'd expect from an economic miracle. Now, here's where it gets really interesting. This week, the House voted 219 to 211 to reject the tariffs on Canada. That's the first time the House, controlled by the president's own party, pushed back on a signature policy. 6 Republicans crossed party lines. Within minutes, the president posted a warning. Any Republican who votes against tariffs will suffer the consequences come election time. That tells you something. Even inside the party, there's growing unease about the economic impact. Businesses back home are feeling the squeeze. Constituents are dealing with higher prices. The Senate had already voted to reject the Canada tariffs earlier, but both chambers would need to agree, and then the president would need to sign it, or face a veto override, which is unlikely. So the pushback is symbolic, but symbols matter. They signal a shift in the political calculus. Meanwhile, deals are being cut. India just released a framework for a trade agreement. Tariffs on Indian goods would drop from 25% to 18%. In exchange, India agreed to stop buying Russian oil and start reducing tariffs on American exports. That's the carrot side of the tariff strategy. Use pressure to force negotiations, then ease off when you get concessions. It works sometimes, but it comes at a cost. Every month those tariffs are in place, businesses and consumers pay the price. And then there's Canada. The president recently threatened a 100% tariff on Canadian goods. That's not a typo. 100%. Over Canada's proposed trade deal with China. Canada is America's largest trading partner. A 100% tariff would be economically devastating for both countries. It's almost certainly a negotiating tactic, but the uncertainty alone is damaging. Businesses can't plan when policy changes by the week, and uncertainty is the enemy of investment. So what does all this mean for you? If you're an investor, here's the honest truth. Tariffs create volatility. Every headline about a new tariff or a trade deal or a congressional vote, it moves markets. And that noise can shake you out of good positions. The key is to separate signal from noise. The signal is this: the global economy is adjusting. Trade flows are being rerouted. Some industries benefit, some get hurt, and the full effects take years, not months, to play out. Don't make portfolio decisions based on one tariff headline. If you're in manufacturing or domestic-focused companies, tariffs have been a tailwind. If you're in companies that rely on global supply chains, tech, auto, retail, they've been a headwind. Look at where your exposure is. Understand the second-order effects. And don't assume that tariff policy stays static. It changes constantly. Here's my bottom line. The tariff experiment isn't a clear win or a clear loss. It's messy. That's the honest answer that nobody on either side wants to give you. GDP recovered, but not because of tariffs, despite them. Inflation is sticky, partly because of tariffs. The stock market did fine, but lagged the world. Congress is pushing back. Deals are being made, but slowly and expensively. The one thing I know for certain is this: we're not done. More tariff headlines are coming. More volatility is coming. And the investors who do best will be the ones who stay rational when everyone else is reacting to the latest tweet. Stay focused. Stay patient, and I'll see you next time. Thanks for being here.